Credit Scores 101, A Teen's Guide. Ever wondered what a credit score is and why it's important? Well, let's dive right into it. A credit score, in simple terms, is like your financial report card. You remember those report cards from school, right? The ones that used to make your stomach churn as you brought them home to your parents? Yeah, those. But instead of reflecting your performance in math or English, a credit score reflects your financial behavior. Just like your school report card, your credit score tells a story about you. But instead of telling people how well you understand Shakespeare or solve algebra problems, a credit score tells lenders how well you manage money. It's a 3-digit number, usually ranging from 300 to 850, that lenders use to determine how likely you are to repay your debts. Now you might be wondering, why does this matter? Well, think about it. If you were lending money to someone, wouldn't you want to know if they're likely to pay you back? That's exactly what a credit score does. It helps lenders decide if they should give you a loan and even influences the terms of that loan, like the interest rate. A good credit score can open doors for you. It can help you get approved for a credit card, qualify for a mortgage to buy a house, or secure a loan to start a business. On the flip side, a poor credit score can make it difficult to get loans and can lead to higher interest rates when you do. So, managing your credit score is a bit like studying for your final exams. The better you perform, the more opportunities you'll have. And just like your school report card, your credit score can change over time. It's not a one-time thing, but rather a continuous process that requires good financial habits. So, think of your credit score as your financial report card. It's a snapshot of your financial reliability, and it can have a big impact on your financial future. And just like with your school report card, the goal is to get the best grades possible. So, are you ready to ace your financial report card? Meet Emily, a teenager who just got her first job and is trying to understand all this credit score business. Emily's world is full of exciting firsts. Her first paycheck, her first taste of financial independence, and also her first encounter with the somewhat daunting world of credit scores and reports. She's heard these terms tossed around, but what do they really mean? She knows they're important, especially now that she's earning her own money. She's aware that these scores and reports have something to do with her financial future. They could impact her ability to buy a car someday, or even a house. She's heard they can affect her chances of getting loans or credit cards, but right now, it all feels like a confusing maze of numbers and terms. She's eager to understand, to navigate this new territory with confidence, but it's overwhelming. Emily knows she needs to understand this, but where does she start? The first thing Emily does is to learn about credit reports. Just like Emily, we should all strive to understand what credit reports are. Think of a credit report as your financial report card, similar to a school record. It's a comprehensive document that outlines your financial history and behaviors. Now, let's take a closer look at what it contains. In the heart of a credit report, you'll find a detailed list of your credit accounts. This includes any credit cards, loans, and mortgages you may have. Each account will show your payment history, current balance, credit limit, and the date you opened the account. Next up, we've got your personal information. This is simply to verify your identity. It includes your name, address, social security number, and possibly your employment history. Don't worry, this information is kept strictly confidential. Then, you'll find public records related to your finances. This might include bankruptcies, tax liens, or civil judgments. Yes, it sounds a bit scary, but it's essential to be aware of these as they could seriously impact your credit score. And lastly, there's a list of all the entities that have requested to see your credit report. These are known as inquiries. They can be hard inquiries, like when you apply for a new credit card, or soft inquiries, which don't affect your credit score. Now, you might be wondering, who compiles all this information? Well, there are 3 major credit bureaus in the United States: Experian, Equifax, and TransUnion. Each one gathers information from your creditors and public records, then compiles it into your credit report. And voila, that's your credit report in a nutshell. It's a detailed record of how you've managed your credit over time. Lenders and creditors use it to decide whether they should lend you money or issue you a credit card. So, a credit report is like a detailed record of your financial behaviors. Just like a school record, it's a reflection of your past performance. And remember, just as we strive for good grades in school, we should also aim for a good credit report in the financial world. Emily learns that her credit score is based on 5 main factors. Let's take a closer look at these components and how they influence the mysterious number known as a credit score. The first and most crucial factor is payment history. This shows whether Emily has been consistent in paying off her debts on time. A track record of timely payments sends a strong signal that she's reliable and can manage her financial responsibilities well. Next on the list is amounts owed, often referred to as credit utilization. This is basically the ratio of Emily's current debt to her total available credit. If Emily owes a lot compared to her credit limit, it can indicate that she's over-reliant on credit and may have trouble paying it back. The third component is the length of credit history. This factor looks at how long Emily's accounts have been open and the age of her oldest and newest accounts. A longer credit history generally means more experience managing credit, which can be a positive sign to lenders. Fourthly, we have the credit mix. This refers to the variety of credit types Emily has, such as credit cards, student loans, or a mortgage. A diverse credit mix can show that Emily has experience managing different types of credit. Finally, there's new credit. This factor counts the number of recently opened accounts and recent inquiries for new credit. Opening several new credit accounts in a short period of time can signal risk to lenders, as it may look like Emily is experiencing financial difficulties. So there you have it. Each of these factors, payment history, amounts owed, length of credit history, credit mix, and new credit, play a unique role in calculating Emily's credit score. They paint a picture of her creditworthiness and help lenders decide if Emily is a safe bet or a risky gamble. Remember, understanding these components is just the first step. It's equally important to know how to manage them effectively to build and maintain a healthy credit score. Each of these factors contributes to Emily's overall credit score. And with this knowledge, Emily is well on her way to becoming a credit score superstar. Now, Emily wants to know how she can improve her credit score. Improving a credit score might seem like a daunting task, but it's not rocket science. It's all about good financial habits and a bit of patience. So, let's dive into some strategies that Emily or anyone can adopt to give their credit score a healthy boost. First and foremost, pay your bills on time. This might sound like a no-brainer, but it's a crucial step that can't be overstated. Creditors want to know that you're reliable, and consistently paying your bills on time is a great way to show them just that. This isn't limited to credit card bills either. Utility bills, student loans, car payments, they all count. Next up, reduce your debt. Easier said than done, right? But remember, it's not about eliminating all your debt overnight. It's about steadily decreasing it. Try to pay more than the minimum due on your credit cards each month. This will not only help to lower your debt, but also decrease your credit utilization ratio, which is a fancy term for how much of your available credit you're using. The lower the ratio, the better it is for your credit score. Avoiding new debt is another important strategy. This doesn't mean you should never borrow again, but rather, be thoughtful about what you're taking on. If you're considering a new credit card or loan, make sure it's for a good reason and that you have a plan to pay it back. Finally, keep an eye on your credit report. Regularly checking your report can help you spot any errors or fraudulent activity that could be hurting your score. If you find any, don't hesitate to dispute them. Remember, improving a credit score is a marathon, not a sprint. It takes time and consistent effort. But with these strategies in hand, Emily can start making small changes that will have a big impact over time. With these strategies, Emily can start working on improving her credit score. But why does Emily need a good credit score? Well, let's dive into the whys and hows. You see, a good credit score is like a golden ticket that opens a world of financial possibilities. For starters, it can help Emily get her hands on a credit card, allowing her to make purchases even when she's a little short on cash. Plus, with a good credit score, she can qualify for a higher credit limit, giving her more flexibility in her spending. Not only that, but a good credit score can also make it easier for Emily to get approved for loans. Whether she dreams of owning her own car, going to college, or even buying a house someday, a good credit score can make these dreams more achievable. But it doesn't stop there. A good credit score can also get Emily lower interest rates on loans and credit cards. This means she would pay less over time. Imagine buying a car with a loan. If Emily has a good credit score, she could end up paying hundreds or even thousands less in interest compared to someone with a poor credit score. And it's not just about saving money. A good credit score also gives Emily more negotiating power. If she walks into a bank or a dealership with a high credit score, she can use it as leverage to negotiate for better terms and rates. Moreover, having a good credit score can even impact Emily's ability to rent an apartment, as many landlords check credit scores to determine if a potential tenant is reliable. In a nutshell, a good credit score is a key ingredient in Emily's recipe for financial success. It empowers her, giving her the freedom to make choices that suit her lifestyle and her dreams. It's like a financial passport, allowing her to navigate through life's big purchases and decisions with ease. So the next time Emily wonders whether she should bother about maintaining a good credit score, she'll remember that it's more than just a number. It's her ticket to financial freedom and options. A good credit score gives Emily more financial freedom and options. So, what has Emily learned about credit scores and credit reports? Well, we've taken a fascinating journey into the world of finance, where credit scores and credit reports are as vital as air. Emily, like many of us, began this journey feeling a little lost, not quite understanding the importance of these terms that sound more complicated than they are. She discovered that a credit score is a 3-digit number that lenders use to assess how likely she is to repay her debts. It's like a financial report card, where the grades are determined by factors such as her payment history, the amount of debt she has, the length of her credit history, the types of credit she has, and her recent applications for new credit. Emily also learned about credit reports. She found out that these are records of her credit history, including the types of credit she has, the length of time her accounts have been open, and whether she's paid her bills on time. It's like a diary, detailing her financial behavior for lenders to read. But what's the point of all this? Emily wondered. Why does it matter? The answer is simple. A good credit score can open doors. It can make it easier to get a credit card, buy a car, or even buy a house. It can also mean lower interest rates, which can save her a lot of money over time. Emily realized that improving a credit score isn't magic. It's about good financial habits. Paying bills on time, keeping credit card balances low, and not applying for new credit too often are all steps in the right direction. By understanding these concepts, Emily has taken a massive leap towards managing her financial future. She's learned that her financial actions today can impact her opportunities tomorrow. Understanding your credit score and report, like Emily now does, is an important step in managing your financial future. Thank you for watching and sharing by Leader in You.